Hello and welcome back to James Talks Property. My name's James, and if you're new here, this channel is all about helping investors build and grow their knowledge about property investment and the UK property investment market so they can mitigate mistakes and build their wealth in the long term. Over the last 5 years, I've helped thousands of property investors scale portfolios across the UK. I'm the co-founder and managing director of a property investment business called Freighter Property Partners, but this channel is all about helping you build and grow your knowledge. If you find this interesting, don't forget to hit like, subscribe to the channel, and send this to anyone that might also be interested. Today's video is all about diversification of your property portfolio. We'll discuss what it is, why you'll do it, and how to do it effectively in the modern market. So why would you do it? The easy answer is if you only invest in one property type or one location, your property portfolio could be exposed. Before we dive deeper into why we might diversify our property portfolio, let's discuss what diversification actually is and why we might do it. Diversification within property investment is essentially where you buy property or invest in property into multiple different property types or locations. It's all about spreading your risk and making sure your portfolio isn't overly exposed to changes in market or legislation within specific areas. You can diversify by investing into different locations. So you might have a few locations in which you might invest. That could be the Northwest could be one, or Manchester could be one. Another location could be Nottingham, and so on and so forth. Then you're benefiting from the positives in those areas, but also you're not just tied to one specific location. You can also do that with strategy. Although strategy is a little bit more stringent than location, you might want to look at a few things that mean that you have a fully diversified portfolio. We might start looking at things like buy-to-lets at first, but as you grow a portfolio and you want to focus on some slightly better cash flowing assets, you might buy a HMO or look at short-term lets. This might also mean that you target a variety of tenant profiles. So we obviously now know that we're going to diversify in order to mitigate risk, but why would we do that further? First, it's quite obvious in terms of location. For example, if you're investing in somewhere, let's take Doncaster for example. If you've invested in a property at Doncaster because of a major employer within logistics, and that employer then pulls out and goes to a different area of the country, you may be subject to a change of market conditions within that local area. And that's fine, as long as you've got properties in other locations that will perform better because there's employers moving to those areas. However, if all of your portfolio is in that location and all of those properties are affected, which might mean a lack of capital growth in the future, then obviously your risk is a lot higher. As well as this, diversification also gives you a more consistent cash flow. Let's say you've got one property and that tenant doesn't pay their rent that month. That means you, as a landlord, are still going to have to pay your mortgage or your interest on your mortgage that you've taken out. However, if you've got multiple properties, the profit that you've got from each of those properties can contribute towards that mortgage and mitigate that risk further. This is actually quite an easy topic to understand on the surface level, but what does it actually look like really to someone who's scaling a property portfolio? The truth is, you're probably going to start small. You don't have to do everything all at once. You don't have to buy one house in the Northwest and then a flat in the East Midlands. You can start by slightly changing in terms of the location or the property type and build from there. Or it might mean that you buy your first few properties in the Northwest. Once you've got 3 properties, you want to start to diversify, and then you start to look at other locations. Remember, all of this has to come back to your goal again. Don't just invest just to diversify. It needs to be an area or a property type that will still help you achieve your goals. When I've worked with investors, what we do a lot of the time is look at 3 main locations. That could be 3 areas within the country or 3 major cities that they can invest in property. As an example, let's take Greater Manchester, Leeds and Nottingham as cities. The first 2 properties might be one in Manchester and one in Leeds. Great, they've got 2 properties, they've diversified and they've spread their risk. The next 2 might just be the same locations. You don't have to diversify every single time you buy a property. Having said that, once that investor has 5 or 6 properties across those locations, they may then start investing into Nottingham. I wouldn't suggest that every time you buy a property that you buy in a different city, because then that will mean management could potentially be quite difficult. The chances are you're going to want to have a local letting agent who's going to manage that property. So if you've got 2 or 3 in one area, they can manage those 3 properties and so on and so forth, rather than having 8 different properties with 8 different management companies and getting called by 8 different people if there's an issue with one of the properties. It's why when I'm starting out with property investors and they say they only want to look at flats or they only want to look at houses, I try and have an open discussion with them that is fine as of now, but as they scale, and if they're serious about scaling a diversified portfolio, the chances are they're going to buy both anyway. The main mistake I see people make when they're trying to diversify their portfolio is diversifying too quickly and not understanding the market that they were going to invest in. Yes, we want to diversify, but also do your research. Don't just buy a property in a different city every single time you buy, because then you might have quite a loose or messy portfolio, which is really difficult to manage in the long term. And that is essentially that. Remember, diversification isn't just about buying more properties. It's about buying smarter and reducing your risk. Get clear on your goals, take your time, and build something sustainable. Thanks again, and I'll see you in the next one.